Welcome back to the Supply and Demand Pro Trader series. In this video, I teach you how to master supply and demand like a pro. This is lesson 2. Today we are diving deep into the fascinating world of supply and demand. But first, let's take a trip down memory lane and explore how trading has evolved over the past 2 decades. Buckle up, because this historical journey will lay the foundation for our understanding of the inner workings of the financial market. And of course, we'll end with an exciting look at the market concept itself. Let's hit the gas. Hey there, if we haven't met yet, I'm Bernd. I'm a full-time trader with 10 years of experience. I manage $2.4 million in prop-firm capital and lead a licensed investment consultancy based in Dubai. We specialize in providing real trading education, and the best part, I get to travel the world while trading. How do I do it? Well, I rely on my 2-step mechanical process, but enough about me. Let's dive into the lesson. Alright everyone, let's dive into a little floor trader history lesson with fast-paced excitement. Imagine trading 3 decades ago in the 80s and 90s when we didn't have broadband internet for everyone. It was the era of floor traders. Just like in the movies, those traders, wearing those colorful and funny jackets, stood on a noisy trading floor, yelling, screaming and waving papers like their lives depended on it.
All the different colors and different designs that you see down there was to make you stand out among the crowd.
But wait, there's more. On the floor, we had the clerks who handled all the orders coming in from people who wanted to trade. Who were these people? Well, it's fascinating because it was a mix of big banks, institutions, and even the average Joe like you and me. Now picture this. No broadband internet, no instant buy and sell buttons like we have today. How did the clerks receive those orders back then? Get ready for this. They used fax machines. Imagine being a clerk, arriving at work before the market opens. Your heart races and you receive your first orders through the buzzing fax machine. It was a different world, huh? Imagine this. You've got a buy order for 1,000 shares of Meta priced at $150. You place it on the left side of the desk. Boom. Right after that, a sell order for 500 shares of Meta comes in, priced at a cool $200. You put it on the right side of your desk. Before the market even opens, your desk is flooded with orders. To keep things organized, you sort them by price, whether it's a buy or sell order. Picture it. Stacks of orders all lined up, ready to go. But wait, are these orders already filled or are they still waiting for a match? Of course, they're unfilled. They've just arrived and are waiting to be snapped up by the traders on the floor. And then the market opens. The clerk takes those unfilled orders and hands them to the traders. They find the perfect match and voila, filled orders. Now here's the interesting part. When the price of Meta dropped and crashes into a massive stack of unfilled institutional buy orders, what happens? The price goes up, my friend. Why? Well, it's simple. When demand exceeds supply, prices soar.
So who are all these guys yelling and screaming, and what are they doing? As the exchange grew in popularity, at times there'd be more sellers than buyers, or a demand with no one there to meet it. Entrepreneurs saw an opportunity to take advantage of this imbalance, working in the middle as both buyer and seller.
But hold on tight, because this ride isn't over yet. Now imagine the price of Meta skyrockets and collides with an enormous pile of unfilled sell orders. What do you think happens now? Yes, you're right. When supply is greater than demand, prices take a nosedive. Back in the 80s and 90s, stacks of paper orders ruled the trading floors. You could touch them, physically feel their presence. But guess what? The trading game hasn't changed that much. The only difference is swapping those old fax machines for speedy broadband internet. So here's a question for you, my fellow retail traders. If you could place an order, where would you want it? On a measly little stack or on a colossal mountain of unfilled orders? Obviously, the bigger the stack, the better. Those big stacks move the market, my friend. Think about it. Your ultimate goal as a retail trader is to find those massive stacks of unfilled institutional orders. That's where the real action happens. Now it's time to jump into the slides.
Okay, so let's get one step deeper behind the scenes and have a look at Meta as an example. Imagine you have Meta trading at $201 a share. Exactly at $201, not at 200, not at 202, exactly at $201. At this specific price, you have 96 willing sellers. They're willing to sell. They haven't sold yet. And on the other side, you have 60 willing buyers. They haven't bought yet. So they are willing buyers at this specific price. Since there are willing sellers and willing buyers, have they filled their orders yet, or are they still unfilled? Unfilled, correct? Because they are willing to buy and sell and haven't bought and sold yet. So what happens next as a next step? We have 60 transactions taking place at this specific price. Willing buyers canceling out willing sellers. What remains? 36 willing sellers and 0 willing buyers. And that's the important piece of information here. We don't only have more willing sellers than willing buyers, but we also don't have any single willing buyer left at that specific price. Hence, 0 willing buyers. Based on that information, what ultimately has to happen with price? It has to drop. And what kind of candle do we get? A red or green one? A red one, obviously. And that's now crucial to understand. Price can only change when one force, buyers or sellers, in our example, buyers, become 0 at a specific price. The science of trading is to identify the origin of this change, because in this origin, we find the unfilled orders, in our example, the unfilled sell orders. What is the whole teaching point here? Let's summarize it to that point. Unfilled orders cause price to turn. Another word for unfilled orders is supply and demand. If price is declining and it reaches a price point where there is greater demand, price will stop falling and turn higher, and vice versa on the supply side. So unfilled orders cause price to turn, or in other words, a lack of significant supply and demand. Another way to say that is filled orders facilitate price movement. All right? So filled orders facilitate price movement. When you look at any price chart of any market for any financial objective, when you are seeing on the chart are those two things and those two things only, filled and unfilled orders, because everything on the chart represents those two things. But a chart by its nature is actually only made up of one thing. It shows you where the filled orders are. That's a print on the screen, a candlestick. Our goal as a trader is to find the hidden unfilled institutional orders by identifying the footprints the institutions left on the chart. This area we call the origin, an area on a chart where one of the two forces became 0 at a specific price. So let's apply step by step in a very basic form what we just learned. Let's look at the candles. In which direction does price go? It's in a range, or could we say it goes sideways? Since price goes sideways, what does it imply in regard to the force that is in control? Is supply or demand in control right here? Well, since we cannot really identify who is in control, does it imply that there's a huge imbalance, or rather balance, in the current price range? It's balanced, correct? Since price is rather balanced, we cannot identify institutional activity at this stage. Since we now see a big drop in price, what does this drop in price tells us about the force that is in control? Is supply or demand in control? It's without any doubt supply. And based on the drop you see, is that a stair-stepping drop with small red candles or big, strong drop in price? It's definitely big drop. So who caused that drop, you and me, or big banks and institutions? It's clearly an institutional activity. We would have never been able to cause a drop in price. Take this into account and think about it logically. The only reason why price dropped is because of an imbalance. One of the two forces, so in this case the willing buyers, became 0 in this area. It was inevitable that price dropped, since in this area we have 0 willing buyers but still a significant amount of willing sellers left. Bottom line, supply exceeded demand. We identify the origin. We highlight the origin with the yellow box to visualize the area where price left with a very strong move. We take this area of imbalance where supply exceeded demand and draw 2 horizontal lines to the right. So what do we want to do when price comes back to that area? We want to go short, sell to enter. We place our set and walk away. Because when price comes back, what do we expect to happen and why? We expect price to enter this supply zone since we have 0 willing buyers in the supply zone and a significant amount of unfilled sell orders. Supply will exceed demand and consequently we will see a drop in price. So we expect price to enter these supply zones. And as I said, since we have zero willing buyers in the supply zone and a significant amount of unfilled sell orders, supply will exceed demand eventually and the price will drop. Let's make another example here again. Let's look at the candles. In which direction does price go? It's in a range. Since price goes sideways, what does it imply in regard to the force that is in control? Is supply or demand in control right here? Again, same story. Since we cannot really identify who is in control, does it imply that there is a huge imbalance or rather balance in the current price range? Since price is rather balanced, we cannot identify institutional activity at this stage. Since we now see a big rise in price, what does this rise in price tell us about the force that is in control? Is supply or demand in control? It's without any doubt demand. And based on the rise you see, is that a stair-stepping move with small green candles or a big strong rise in price? It's definitely a big rise. So who caused that rise? Is it again you and me or big banks and institutions? It's clearly an institutional activity. We would have never been able to cause that rise in price, take this into account and think about it logically. The only reason why price rose is because of an imbalance. One of the two forces, so in this case, the willing sellers became zero in this area. It was inevitable that price moved up, since in this area we have zero willing sellers, but still a significant amount of willing buyers left. Bottom line, demand exceeded supply. We identified the origin. We highlighted the origin with the yellow box to visualize the area where price left with a very strong move. We take this area of imbalance where demand exceeded supply and draw two horizontal lines to the right. Here we go. Now, what do we want to do? When price comes back to the area, we want to go long buy. Place our set and walk away. Set and forget and get a life, basically. So, because when price comes back, what do we want to do? And what do we expect to happen? We expect price to enter this demand zone. Since we have zero willing sellers in the demand zone and a significant amount of unfilled buy orders, demand will exceed supply and consequently we will see a rise in price.
That they're responsible for prices going up or down. The supply and demand drives that. If there's too little supply and demand is high, well, prices are going up. If there's too much supply and demand is flat, prices are going down.
In this lesson, we've discovered a key takeaway. We learned that market prices turn where supply and demand are out of balance, meaning one party becomes zero at a specific price, or actually better call it an area. Therefore, a trader needs to identify in advance the area where price became out of balance. These are the significant market turning points. This area of imbalance is where the trader can find unfilled orders from institutions. Generally, the bigger the imbalance, the higher the number of unfilled orders. Your goal as a professional trader is to find the hidden institutional unfilled orders. Get ready for some thrilling market moves. I hope this video helped you grasp the basic concept of supply and demand. Get ready to dive into the next lesson of my Supply and Demand Pro Trader series. Stay tuned for more exciting content. See you next time on my channel, wishing you happy and safe set and forget trading.